I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight into those burning issues in private markets. Well, private markets are gaining steam into year-end. JP Morgan charting out expansion plans with more companies seeking to shed the mantle of being public. Plus, Comcast Ventures head of funds on startups luring capital at earlier phases in their development. And Babe Ruth's bat hits yet another home run, this time at the auction block. Well, let's get straight into some of these burning issues. With me is Bloomberg's Kelsey Butler, Adam Temkin, and Sonali Basak. Let's start with Kelsey. A big number of big asset managers have been getting into and expanding in private markets. What's JP Morgan Asset Management doing?
So the firm is definitely growing its footprint into private credit. They're doing this a couple ways. For one, they just appointed their CFO, Meg McClellan, into a newly formed role of head of private debt. They're also doing some hiring and potentially some more acquisitions to grow their assets.
What's the goal here? Why is this happening now?
So it's part of a push from investors. Investors really want someone that's specialized in these kind of unique asset classes, and especially when you're talking about alternatives, and there are some, intricacies along the way.
Okay, how much is this coming from investor demand? How much is this coming from the fact that fees are higher in the alternative space?
I mean, that is definitely a driver as well. As fees have kind of compressed along the board, banks are making the smart decisions and boosting fees where they think they'll come.
Is it largely in private debt, or is it also private equity? Is it also in perhaps beaten up existing public debt? I mean, where is the focus here?
So the focus, especially for JP Morgan, is going to be in credit that has collateral backing it. So they really see a lot of opportunity in that. So when there is a downturn, they can go in and seize the assets if need be. They're also seeing opportunity in special situations and distress.
Collateral backing it, which brings us perfectly to Adam Temkin and the underlying supply and demand fundamentals when it comes to commercial mortgage-backed debt in particular. You recently wrote a piece talking about the year ahead. What are bankers expecting in terms of supply?
CMBS was up 20% this year, may go up another 20%.
In terms of issuance?
In terms of issuance, could be close to $140 billion next year. Low rates, borrowers are locking in those fixed rates, search for yield, and a mini maturity wave where borrowers may refinance next year because of the low rates.
So it's not necessarily a lot of net new supply as much as just sort of recycling existing securities? Is that the idea?
That's right. It's a lot of refinancings, and not only that, but also a search for yield, great relative value there.
There's a concern that people have with the commercial mortgage debt market recently, or commercial mortgage market just broadly, because there's been a weakening in the underlying market. What are you hearing from bankers and investors on their concerns about that?
Retail is just a small portion. It's actually lower leverage in the post-crisis CMBS and great relative value. CMBS, like a lot of structured markets, did not tighten in. The spreads did not tighten in as much as, let's say, investment-grade corporate bonds. So it's great relative value. All the banks are saying get in it now before there's a rally in CMBS next year.
And when you say retail, it's because there has been a whole world of pain in the mall space and the retail-focused space, but not so much elsewhere. Is that the idea?
Correct. Delinquencies in some CMBS that have malls in them.
Okay.
But the collateral is getting a lot cleaner now.
Yeah, well, it's been washed out, which brings us to Sonali. And when it comes to demand for some of the assets, it brings us to the fact that more public companies are trying to go private for a variety of reasons, in no small part because of the money flooding into this area. And Hudson's Bay, we know, for example, one shopping-based company, Sonali, has been trying to go private. What are we seeing with that in particular?
With Hudson's Bay in particular, there's a little bit of an issue here because there's an investor that really wants a higher valuation here in terms of this take-private deal. But like you say, they're not only companies that are looking to go private that are already in public markets that don't really like this pressure from shareholders, that are not that patient in terms of a turnaround plan. And at the same time, you have more companies that might be looking for a different strategic exit while they're entering public markets as to not face that investor pressure in the first place.
Well, and that's something that we just saw in the energy space with a takeover that was done, I believe, by Blackstone, but it was done at a pretty high valuation, right?
It was 15% 15% higher, and this is Blackstone Infrastructure for Tallgrass Energy. It was done 15% higher than their initial offer was. It's really interesting to see these public shareholders push back at these big private equity firms and say, listen, you need to pay up a little more to make this worth our time to take this out of the public market.
And just more broadly, Sonali, can you give us a sense of what the advantage is for companies to be private over public at this point?
Listen, Lisa, a lot of people are having a lot of issues with corporate governance. A lot of the things that flew in the past, dual class structures and whatnot that allowed management teams to do whatever they wanted to do, are not flying with the investors anymore that want more control. Especially these big index funds, they've taken a more active role in the market. Meanwhile, you have private equity that's willing to say, okay, let's be more patient, while we also have co-investors, big family offices, pension funds that are willing to put more towards our deals. With that said, valuations, according to Morgan Stanley Wealth Management, are as high on average for LBOs as they've been since 2000. So earning a return on these assets are going to be a more difficult thing moving forward.
Sonali, thank you so much, and to all of our reporters, we really appreciate it. Which brings us perfectly to my next guest, Karen Davies, Huntington National Bank Managing Director of Private Equity. And I want to focus on valuations and just how high they've been. What have you seen this year in terms of pushback or reluctance to do deals on the part of private equity firms because of those high valuations?
This year has really been 2019, sort of a repeat of 2018 in terms of valuations, the peaking of the 10, 11, 12 times range, the high multiples even above that in the healthcare sector. I don't see there being a lot of pushback on these transactions. I just see a lot of larger equity checks being written to basically chase the best assets that are out there right now. They have tons of dry powder to do it, and if they want an asset and it makes sense for their portfolio, they're going to write a larger equity check for it.
You said they have a lot of dry powder, and that's the key. How much are these deals being driven by the amount of cash that they have versus the idea that perhaps there's value in these deals being done?
Yeah, it's a tricky wicket to figure that out, right? We've got, I think it's anywhere from $2 trillion globally of dry powder. We've got sovereign wealth funds coming in. You have family office joining the party as well. And so you have all of this capital on the side from the investment standpoint. GPs wanting return, right? The exits have slowed down. But then you have access to the credit markets that is huge. I mean, you have low borrowing rates at the traditional regular banks. You have access to the capital markets, and you have access to direct lenders who are now at the table doing much larger deals and doing it alone. So I almost feel like these valuations are a new norm, even if you start to slightly slow down.
What could potentially trigger a shift here? I mean, there's a concern as valuations get higher and higher and profits perhaps don't match pace.
Right.
And you have 70% of all the companies that IPO'd, I believe this year, were cash flow negative. At what point does this become a real fundamental problem?
Well, I think if you're investing in certain sectors that could be cyclical, that could be a problem because you're you're in the automotive space. Maybe you are heavy into retail, the old school brick and mortar retail. That stuff is going to suffer. It already is suffering. Transportation is already showing a little sign of weakness. If we start seeing housing start slow down and you're in building products, I think it's just going to force the investors to pick a little bit more of a heavier focus on the non-cyclicals. So spend a little bit of time in the food and beverage space, spend a little time in automotive aftermarket space. It's going to force their decision making to a place that it could be a little bit more stable and cycle resistant.
What are you looking for in terms of 2020 M&A and just activity in general, particularly in the middle market space, because that's where you focus,
That's where we focus. So at Huntington, I sit inside of Cleveland, Ohio, but our bank is headquartered in Columbus, and so our footprint is the entire Midwest. So we see these middle market companies that private equity comes in to buy every day. Oftentimes we bank them. I think we're going to see a pace in 2020 that is really the same of 2019. We're hearing from our companies, from our PE buyers, that they are very optimistic, that revenues are up, that they have CapEx spend budgets in mind to keep up with the growth. So I do think you're going to see another 2020 year that matches 2019 in M&A, while the economic indicators are as favorable and the market is favorable.
So you think that valuations are going to increase to a similar degree as they did this year?
I think they're going to stay relatively the same, but I think certain sectors are always going to push the edge: IT, fintech, healthcare.
All right, thank you so much for being with us. That was Huntington National Bank's Karen Davies. Coming up, this week's Power Player, Comcast Ventures' Amy Vance. She says there is a silver lining to high valuations.
There's no question the valuations are high across the spectrum. But again, we see that as an opportunity.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Play, our look at some of the most notable names in private markets. We talk a lot about the mega deals getting done in venture capital, with mega funds like SoftBank attracting a lot of attention. Perhaps because of this, some funds are increasingly looking at the smallest startups for better value right now. I spoke about this recently with Amy Bantz, head of funds at Comcast Ventures, which is the venture capital affiliate of Comcast.
Our investment analysis looks very much like the investment and analysis, I imagine, of a standalone fund. The first thing we ask ourselves is, how good is the team? That's critically important. Then we look at the product. Is it a compelling product? And then ultimately you ask, is there a product market fit that will result in profitable growth? We do go one step further in that we ask ourselves, is there something that we can bring to the table in addition to money? And that goes back to leveraging who we are, our platform, and our assets.
How would that translate in actuality? In other words, does that mean, for example, advertising on the Comcast platform or the marketing lines that you guys have? What kinds of ways could you leverage that?
Exactly. We have a division in the fund called Forecast Labs. Forecast Labs offers a number of products, including television advertising product, where we help our very early stage companies realize that TV advertising can often have a better ROI than other forms of advertising. In addition, we have a white glove broadband service, which you can imagine is critically important to a company just launching. We have a direct marketing service, any number of other products that we are able to create out of the fact that we are Comcast and we invest off this incredibly large platform.
You talked a little bit about the mega funds leading to mega valuations and how you don't really want to play in that space. But I'm wondering, given how much money has been raised, I imagine there's also a lot of bidding going on at this seed stage. I'm wondering how valuations appear to you at that point in a company's evolution.
Yeah, there's no question the valuations are high across the spectrum. But again, we see that as an opportunity. We at Comcast Ventures see that as an opportunity in that we are increasingly able to bring more than money to the table and win investments at a very early stage.
And going forward, you said that the main motivation is financial, that you're not there as a philanthropy arm, that ultimately you want these companies to be successful and make money. What kind of returns are you looking for?
We're looking for venture returns. We want to see 3x, 4x, 5x, 20x if possible. So you're absolutely right. At the end of the day, we measure our success based on financial returns.
There's been also a lot of focus on tech startup valuations and how high that particular area, how lofty the valuations have gotten there. Do you think that that's an area of particular concern?
I actually think we're going to see the pendulum swing there in 2020. There's already considerable amount of talk in the market about good growth, profitable growth, sustainable growth, instead of growth at any cost. So I do think that you'll see those valuations moderate to some extent in the next year.
Does that mean a washout of some sort, with some companies either folding up or consolidating into others?
No, not necessarily. I think it probably suggests that you're going to have companies sort of focus more on keeping their heads down and realizing margins that result in profitable growth.
Just lastly here, I'm wondering, are there particular industries where you're completely avoiding the startups?
Nothing that we're avoiding, but we're certainly seeing a lot that we're excited about. The categories that we, Comcast Ventures, will be focused on in 2020 are categories like insurtech, real estate tech, enterprise automation, cybersecurity, and then, of course, one that I'm particularly excited about is the rapid growth in the audio ecosystem.
That was my conversation with Amy Banz, head of funds at Comcast Ventures. You know, it's important to get some context to understand why more venture capital firms may want to look beyond the mega startups. Let's just take a look at 2018. It set a new annual record for U.S. venture capital investment at nearly $137 billion. It's on pace to surpass $100 billion again this year. This is according to PitchBook data. And as the market develops, later stage startups are starting to look a lot more like public companies, which fundamentally changes their risk and return expectations. As a result, a lot of firms are taking a look at the earlier phases of development for perhaps more opportunities. Coming up, unloading Uber co-founder Travis Kalanick selling $350 million more of his shares this month. The details next. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz, and this is Bloomberg Money Undercover. Time now for Billionaire Beat, where we like to highlight the money behind public companies that often go to a lot of private investments of all types. Recently, there was a reorganization of a power corporation of Canada that included two brothers stepping down as co-chief executive officers, casting a spotlight on the media-shy Desmarais family. Joining us now from Montreal is Bloomberg's Sandrine Rostello. Sandrine, could you just first talk about who are Andre and Paul Desmarais?
So these are two brothers who are part of a family that's basically sitting on top or near the top of the Canadian business establishment. Their father had taken over that company in 1968. Their father had built an empire, financial, and at some point a media empire, starting basically from scratch, from a bus company he inherited in a small town. And he was a very astute businessman, not afraid to make deals. He grew this big company in this post-war era. The family became very connected, very powerful. They have an estate 300 kilometers north of Montreal, where a lot of heads of state came to relax and play golf. And the sons took over in 1996. And after 23 years, they're stepping down.
Yeah, and I'm wondering, this is one of the wealthiest companies in Canada. I believe they have an estimated $6.4 billion in net worth. Do we have a sense of where they put that money, what they do with it?
So you should know that this is a very media-shy, is a polite way to put it. It's a very discreet family. Big philanthropists in Montreal in particular. When it comes to their own money, the family money, of course, has a huge investment in the shares of the company. They control the company. They control the votes. So through these investments, they have a hand in a lot of indirect investment and holding company. In terms of personal investment, there's a few interesting things from one of the brothers, André. There was media report of an investment in Formula One, for instance, but also more local things. For instance, he started some organic farms not too far from Montreal, where young farmers get trained in a particular organic growing method. And hopefully the idea, at least he says, is to give the tools for these people to go and start these farms and show you can actually make a decent amount of money growing organic vegetables.
All right, thank you so much, Bloomberg's Sandrine Rostello. We're going to stick with billionaires because Travis Kalanick is having the sale of the century. The Uber co-founder sold $350 million more of his shares this month, bringing his total sale to more than $2.1 billion. Joining us now in London is Bloomberg's Thom Metcalfe. So can we have a sense of what he's doing with all of this money as he sells and liquidates his holdings here?
Yeah, so that's the sort of big topic of conversation in Silicon Valley. I mean, this is, one of the great liquidity events of the year. As you say, he's kind of sold about $2 billion. So one thing we do know is he's using some of that for his next startup, something called Cloud Kitchens. And effectively that's sort of supplying, they're known as dark kitchens, basically to restaurants who who want to do delivery services, but don't actually want to have that in their own restaurants. That's a pretty capital-intensive business, so he's put about $300 million into that, and it's doing pretty well. He seems to have the knack with private companies, because the latest valuation from a January investment by the Saudis valued that at about $5 billion, so not a bad return for Travis Kalanick there. But that leaves a huge amount of money left, you know, kind of on the table, and that's sort of the guessing game right now. Not really sure what he's doing with it, and it's all in cash, so he's very liquid, and whether there's a big opportunity out there that might emerge, or he's just playing it conservative and wants to get out of Uber and sit on his fortune for the moment.
Yeah, when you say he has a knack for it, he certainly has a knack for getting the valuations up high, although Uber shares have taken quite a fall since the company went public. I'm also wondering how typical it is to see a co-founder liquidate so much of their holdings right after the IPO.
Yeah, at least I've been covering this space for 6-7 years, and I've never seen something at this pace. It's pretty extraordinary, really. So just to give you a bit of context, his co-founder, Garrett Camp, who's still at Uber, he's sold off about maybe 35 million of his shares out of a $2 billion portfolio, and that's much more the pace you typically see. But obviously Travis Kalanick, he was sort of ousted as the CEO, and he may feel his sort of time is done at Uber, and certainly there's been filings out there that suggest he's planning on selling his entire stake. So, you know, as recently as November, I think the stake was something like, what would it be, sort of $2.5 billion, and it's now down $2 billion to 500 or 600 million. So it's an absolutely extraordinary pace of sale.
Thom, really quick, do Uber investors care about this, care about his sales?
Doesn't seem to be affecting the share price too much. As you say, the share price is down, but that seems to be unrelated to sort of the pace of the sales. So it seems people have kind of sort of baked in the idea that Travis Kalanick may not have much of a role left at Uber.
Bloomberg's Thom Metcalfe, thank you so much for that. Speaking of big money, it's time for this week's big number. It's a nail-biter. Babe Ruth hit his 500th home run 90 years ago against the Cleveland Indians. His Yankees lost the game, but his bat that day recently sold for a little over $1 million. After the Sultan of Swat whacked the ball out of League Park, it rolled down nearby Lexington Avenue. That, according to newspaper accounts, Ruth was the first player to reach the home run milestone. And that does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. From New York, this is Bloomberg.